All right. Today is Monday, August 8th, and this is a recap for the stock market activities today. And folks, I got a good one for you tonight. And before we start, please check out the video that I released earlier, the Warren Buffett versus Michael Burry. Really interesting. I put a lot of effort into it. So give it a shot and take a look at that video. With that being said, since we have a video already out, I'm not going to spend a lot of time in the in focus segment. So instead, we're going to have a brief discussion here, market commentary, and then wrap it up and move on to the stock market information. Let's start by this. It's not a surprise to anybody watching the stock market right now that the sentiment has changed big time. It used to be really bearish just a few weeks ago, a couple of months ago, and now already we're getting closer to the opposite reading, the extreme bullishness. We're not quite there yet, but we're getting close, and that means an upcoming reversal should be around the corner. Now, when we look at the market sentiment, among stock market timers, they're still kind of bearish. They're not being as jubilous as the NASDAQ-focused market timers. Among those people, they're getting more optimistic by the day, and they're getting closer and closer to extreme optimism. No optimism for gold timers. Gold is in the trash right now. But even among bond timers, the sentiment is getting really bullish, really close to extreme optimism, which means the opposite will happen. This is a contrarian indicator, of course. It doesn't mean that it has to happen right now. The readings could get even more extreme before we see the 180. But as a trader, you look at these sentiment indicators and you become prepared for the next move. When the sentiment was really bearish, extremely so, the traders were ready for the rebound. Now the rebound has been overdone. It is running out of gas, and as a trader, you have to be prepared for the next move. When we look at the risk-on versus risk-off indicators, the US dollar remains in risk-on, meaning dollar bulls are not giving up. At any moment right now, the dollar could pop higher again, specifically after the CPI. But the dollar remains important because if the dollar pops higher again, that will stall any attempt for the continuation of the rebound and the rally in the stock market, because we got corporate earnings and pretty much every single stock, every single company complains about the high US dollar. Among S&P 500 and NASDAQ 100, the sentiment is risk on. We went from extreme bearishness not so long ago. Now we're already at risk on. And therefore, you're seeing the dips being bought, any bad news being shrugged off. But how long can they continue to do that? We have a few speed bumps, if you may, that could actually capitulate the dip buyers and move us back into risk off. Among them, chiefly number one is the CPI. But we have two other headwinds we're going to talk about by the end of this segment. But before we do that, the sentiment in the 10-year is actually at risk off. So the 10-year Treasury went to risk off. The NASDAQ went risk on. Now, can we see a swap between the two where the 10-year Treasury goes into risk on and we see the NASDAQ back to risk off? That will only happen if the CPI comes out really hot, indicating that the Fed will have to be even more aggressive in the next tightening decision. Oil, gold, both of them at risk off. No wonder here, no surprise at all. But is the sentiment getting really bearish in oil? We're seeing more contrarian indicators that perhaps oil deserves a relief rally, at least in the short run. I'll cover another indicator in the commodities coverage, but for now, is it really an opportunity to buy right now? Is the risk-on sentiment in the S&P 500 really justified? Because, remember Tina? Well, Tina is dead. Just like Zed, it's gone. Whether we look at the earnings yield for the S&P 500 or the dividend yield, it's not worth it either way. The bond market says there is an alternative, a better alternative than the current returns based on earnings and dividend yields in the S&P 500. So valuations matter, and so far this is not an opportunity to buy. The stock market remains expensive relative to bonds. And here's a really reliable indicator, the Hubbard NASDAQ indicator. And as you can see, every time the line in the chart in orange, red, whatever that is, gets really elevated in the upside, that is usually an indicator that we will see a pullback. When it gets really bearish to the downside, it is usually an indicator that we will see a rebound. We got the rebound because the reading was really bearish. Now the reading is not extremely bullish, indicating that a pullback is merited, but we have pulled back from a similar reading before. This reading doesn't have to go all the way to extremes before we see a pullback in the stock market, in this case the NASDAQ. But it's really amazing to me how the sentiment changed from extremely bearish to almost euphoric right now. For example, you might have noticed the meme stock mania that took place in the market today, from AMC to GameStop to Bed Bath & Beyond. That was the big one today. Listen to this headline. It reads, Bed Bath & Beyond shares jump more than 50% as message board mentions soar on the troubled, heavily shorted stock. Here we go, here we go. The stupidity is back, the gambling is back, the risk on extremes is back. This is not good news for the Fed because the Fed is looking and saying, wait a minute here, do we have to go even more aggressive? And they should now that we have an insane meme stock mania. At this stage, you would think that kind of excess liquidity is now gone, but evidently not yet. Meaning the Fed will have to go to extremes to get that excess liquidity and insanity out of the market. And the Fed prefers not to do it, but they're going to force the Fed to go crazy with this insanity because so far the Fed's approach is actually working. We will look at inflation expectations, for example. We got today the readings from the New York Fed in the morning. They're down across the board. The 1 year ahead inflation expectations down big. The 3 year ahead inflation expectations erased all of the gains for the year. Likewise, the 5 year ahead, the long run, which is really important for the Fed, is almost down to the Fed target of 2%. So there is progress here. Inflation expectations are responding to the Fed tightening policy, but apparently not the sentiment in the stock market. We will see how inflation is going to respond to the Fed's tightening. If that doesn't come out cooling down big time, we're going to have a major problem because inflation expectations can spike up higher again, just as easily as they went down. Now, besides the CPI, which we're waiting for to come out on Wednesday, there are two speed bumps against the stock market right now. Speed bump number one is this so-called Inflation Reduction Act. And every time you say the Inflation Reduction Act, you have to add the so-called because it doesn't do shit in reducing inflation. That's misinformation, courtesy of the government. But that doesn't mean that the entire bill is bad. I support lowering the prescription drug prices, for example. That's good. I support hitting stock buybacks, the fraud of stock buybacks. But besides that, the bill is absolutely lousy. It increases taxes on regular folks. It's going to increase inflation across the board. And oh, by the way, it might hit the stock market because they're hitting stock buybacks. In the bill, there is a 1% tax on any buyback activity that goes on in the stock market, which means it's going to cost companies more to initiate buybacks. I don't see how that's good for the stock market. I'm not saying it's good policy or bad policy. I hate stock buybacks. I think it should be illegal, but this is going to have a net negative impact on the stock market because there is no Fed put right now. What is the only put that we have left in the stock market? The answer is share buybacks. The financial industry is doing it, information technology across the entirety of the stock market. What's stopping the bleeding right now is share buybacks. You take that off the table or you slow it down, and we got a problem. Likewise, speed bump number two, I should say, along with the CPI and taxing share buybacks, we got really bad news from Nvidia, one of the hottest stocks in the market right now, at least used to. Until the Pelosi's dumped and lost money, of course. But Nvidia came out today and said that the gaming revenue will fall short of their prior guidance or whatever they said before. And the stock market was upset. Nvidia was down, at the lows of the day, it was down over 8%. And we saw chip ETFs, chip names all being dragged down. Now, this is really bad news because you got warnings from Intel, warning that the PC market is slowing down big time. You got Micron also issued a warning that they're seeing oversupply problems. And now you got Nvidia saying, wait a minute here, even gaming demand is going down. Yet you have the geniuses in Washington, D.C. who just passed the CHIP Act, a multi-billion-dollar handout to the corporations in the chips industry to build factories and increase supply because we got a supply problem. And I told you folks in this channel 7 million times, inflation is not a supply problem. Inflation is a cocaine problem. Inflation has always been a monetary phenomenon. The Fed tightens the monetary policy, the demand goes down. Meanwhile, these chip manufacturers, chip designers, whatever they are, they pinned their supply in 2020, 2021 on artificially inflated demand that was bound to go down. So now they have the problem already of being oversupplied, because the demand went down. Now add to that more supply coming from these factories. And oh, by the way, they brag about the CHIP Act creating high-paying wages. So we got a massive problem here. Oversupply of chips, which will crush the margins of these companies. And on top of that, we're going to increase inflation because wage inflation will go higher. These companies have to compete on labor. So we have two different dynamics here will play out in the economy. One is recessionary, the demand going down, and certain industries being oversupplied. And then we have the inflationary side of this insanity in the stock market. And on top of that, the insanity from DC passing a multi-billion-dollar bill amidst the highest inflation in 40 years. And oh, by the way, they have the nerve of calling it the Inflation Reduction Act. Who the are you kidding me? But anyways, the bottom line is I'm staying away from chips, unless they're tortilla chips, of course. But besides that, I'm leaving NVIDIA, AMD, Intel, all of these alone because the demand problem plus the oversupply, that's going to kill margins in these companies. So the great run in chips, maybe this is the nail in the coffin. The CHIP Act. Everything's backfiring. The CHIP Act will kill the chip industry by oversupply. The Inflation Reduction Act will increase inflation. So there you go. Anyhow, let's move on to the stock market coverage, and we start with the performance of the indices today. And here we go. The Dow Industrial Average was higher in the morning, and then it closed pretty much flat with gains of about 29.07 points, or a gain of 0.09%. Similar story in the Nasdaq, but it closed negative, down by 13.10 points, or a decline of 0.10%. The S&P 500 also down by 5.13 points, or a decline of 0.12%. And here's the performance of the sectors of the stock market today. Leading the pack at number 1, capturing the gold medal, energy. Look at that. Number 2 for the silver. Materials. Number 3 for the bronze, REITs. And the laggard of the day is technology. So we went defensive from offensive to defensive. You see the shift? Is it going to last? Does that mean that we go back to oil? Technology goes down? Maybe the CPI would be the catalyst for the reversal of the reversal. What about the advance to decline ratios? NYSE 67% advancing versus 29% declining, and the Nasdaq 59% advancing versus 36% declining. Moving on to futures, commodities, what's going on here? Look at that, we're seeing the rebound. Is it going to last or not? But crude was higher today. The WTI scored gains of 1.75%. Brent was higher by a little over 1.5%. So was gasoline, RBOB, up by about 1%. Yet the laggards, heating oil down about 1%, and then we have natural gas losing ground by about 5.5%. We'll see if we have a rebound in natural gas or not, because it appears that we have some good news regarding the Freeport LNG facility. They're going to start producing earlier than anticipation, so we'll see if that impacts natural gas prices higher or not. We know there's a problem across the Atlantic. Germany needs gas. It's certainly not going to come from Russia. So it has to come from the United States. So we will see a surge in demand by the fourth quarter, assuming that the European economy is not already in a recession by then. We talk about softs. We have a rebound, big one for lumber, gaining ground of about 10% today. Likewise, cocoa gaining about 2% for the day, and coffee futures with modest gains of about 1%. Then we have cotton and sugar futures flattish for the day, while OJ, the winner so far in softs, taking a beating today, down about 3%. Metals, green across the board. Gold, silver, platinum, copper, palladium, all in the green. No problems here. The dollar was muted for the day, slightly to the downside. No wonder why metals are higher. When we talk about meats, muted activities for live cattle futures, be it in the green. And then we have modest gains for feeder cattle futures of about 1.25%. And then the new big tech lean hogs with gains of about 2% for the day. When it comes to grains, flattish, muted across the board, with the notable mover being oats, adding to the gains of yesterday by about 2.5% today. Now, before we move on, when we talk about the contrarian indicators for crude, look at this. The open interest on Brent has actually collapsed, which means there is no demand, there is no interest in buying crude oil futures anymore. Everybody's flocking to the Nasdaq. Risk on, let's party. But while you're abandoning crude, it might be an opportunity here, for a rebound at least. We'll see what happens. The CPI will change all these formations once and for all. Moving on to the big casino, the options market, what's going on here? The hottest table by far was Tesla, the souffle, at around 1.3 million contracts traded today. About 58.5% of those were calls. Tesla was a lot higher in the morning, and then it kind of melted down all the way to the closing bell. Look at the charts in a minute. But Apple at number 2 at around 1.1 million contracts traded today. Look at that. They're buying more puts on Apple because the calls were around 49% today. Different story for AMC. The gamma squeeze goes on. I'm now seeing 25. They're buying the 25 calls. Maybe they'll make it all the way to 25, but they need more. They need to buy the 30. And you got to go a little further, folks. You got to go to September if you want this gamma squeeze to continue. The $30 calls September. Can't guarantee it's going to continue to go on, but the only way to ensure that it's going to continue to go on is by buying call options continuously out of the money. Once that stops, party's over. AMC goes down. But for now, the name traded around 1 million contracts today. About 72.5% of those were calls. Here are the unusual activities that took place in the options market today. Not a lot. Lots of gambling in the meme stocks. We're not going to cover any of that. The Bed Bath & Beyond By the way, the morons bought Best Buy because Best Buy, the ticker is double BY. Bed Bath & Beyond is triple BY. But regardless, even Best Buy went higher today. This is the same stupidity, by the way, that happened back in 2020 when somebody wanted to buy Tesla stock and they bought the ticker TLSA, Telsa. And that stock exploded higher. Here we go again, folks. But anyhow, you see all of these meme trades with 4 days till expiration. They're not really serious. People are just betting. They're shooting their shot. If it hits, it hits. If it doesn't, it doesn't. But we do have a serious trade at the bottom of the table. For the triple Qs, the NASDAQ, somebody's fading the rip. They bought the 302 puts for the expiration date, September 30, with expectations that the name could move down and lose over 6% of its value by then. They paid around $6.50 a piece to enter this trade. All in all, spending around $5.5 million. Watch out, folks. The sinkhole might open. In the meantime, here's the heat map. What's going on here? Mixed across the board, but the risk on in the NASDAQ, not happening today. Chips are down, led by NVIDIA. Even the big caps got weaker as we progressed in the day. The Chinese names are down. The cyclicals are kind of muted. We're talking about the hotels, the casinos, the airlines. Not moving by a lot. What's moving higher? The inflationary trade of energy, the fertilizers, materials, the defensives and utilities, REITs. Some of the big pharma names are making a comeback. We're talking about Bristol Myers and AbbVie. Merck was also higher today. So this is defensive, not offensive. This is a risk off, at least today. Is that going to last or not? Who knows? But it is really interesting that today we went with risk off. Utilities, REITs, big pharma, consumer defensives were leading the way, but also the inflationary trade of energy and materials. And some notable movers are also the EV manufacturers, with the exception of Tesla, which gave up a lot of the gains by the end of the day, but GM, Ford, Stellantis, all in the green big time. Lucid Motor. And the reason is this scam. They're going to give more handouts to the EV manufacturers. That's just bankrupt the country, right? But anyways, in the meantime, it is good for these stocks, and they moved higher. Disney was also an outperformer today. We have earnings coming out for Disney this week, and a lot of folks are buying ahead of time because the stock was beaten down, etc., etc. I actually have a coworker that I talked to today who bought call options on Disney. And I was joking and I said, you're going to lose all your money. And he said, no, I'm not going to lose all my money because Disney will pop after earnings because it's really oversold and beaten down and yada, yada, yada. And I said, you know what? What is Hulu? Is Hulu Disney, Comcast? I believe it's a split between the two. Well, here it is. The champ, Mike Tyson, is not happy with Hulu because they're making a new series about his life, but they're not cutting him in. And I say, you know what? Stop around with the champ. Cut the guy in. Otherwise, Disney stock will go down. It's called the Mike Tyson curse. It might cost you your Mickey Mouse ears, so watch out here. And speaking of Tyson, here's the company Tyson for meats. You're familiar with that, right? It used to be one of the top inflation trades. We talked about it in this channel numerous times. Not anymore. This is an illustration for you that inflation is destroying pretty much everything. Companies can no longer increase prices higher without crushing demand. And therefore, Tyson was down big today. They just can't keep with inflation. So when people say, oh, Powell, the Fed is going to pivot, what the hell are you talking about? Do you see all of these earnings, all of these companies complaining about inflation? We can't do it anymore. They got to crush inflation out of the picture. Now, let's move on to the heat map for the ETFs. Let's see what's going on here. Muted across the board with few exceptions. We have the XRT in the green big time. That's due to Bed Bath & Beyond. We have the SOXS. This is the inverse for chips. That was blasting higher today. The SMH was down on the other hand. Now, when we talk about the stealth mover, look at the XBI. The amazing run in the XBI biotech. Nobody's talking about it. Nobody's paying attention. And the XBI is down, up big since the bottom. And it is a triple bottom for now. So if you're looking for bottoms, can it get any stronger than a triple bottom? Anyways, we talked about the chart about a couple of days ago. Value outperforming growth by a little bit, nothing notable. The gold miners, GDX, blasted higher, not the GLD, although it was positive. Likewise, we have gains for crude, for the USO. This is tied to futures, not so much to oil stocks, and therefore you're seeing the XOP, XLE, the OIH kind of muted, but the USO moving higher. Different story for natural gas, UNG, oil, all down big, and then in internationals, Latin America is blasting higher, led by Brazil, the EWZ lighting up in the green. Let's move on to charts, and we start with SPY, the S&P 500 30 minutes chart. What's going on here? Still within range, no update at all, despite the gap higher. The support remains at 410, the resistance at 416. But this is the first time in a while when we see a gap higher, and then the index closes at the lows of the day. We haven't seen this for a while now, and the bears would argue that we're seeing a bear flag pattern. Now, the candlestick pattern really doesn't matter. The chart is within range. You need to see confirmation. The confirmation would be losing 410 as support. Although it happened before, in the previous double top, the chart closed below 410. And what do you know? It gapped higher the very next day, and thus the pie is in the face. So now we're looking for a confirmation of the confirmation if you want to bet against the SPY, against the rebound so far. Now, the bulls would say, hey, nothing changed today. We're still within range. The sentiment is still good. Nothing changed here. Maybe a pullback because of NVIDIA, whatever. But before you know it, the SPY will blast higher again. The bears would say, watch out. We had a gap and crap. Technically, we have a bear flag pattern. Oh, on top of that, the chart closed the gap and closed the day below the gap. So for now, from a 30 minutes perspective, I'll give this to the bears, at least for now. The bulls, however, still control the daily chart when we look at the continuous contract for the SPY. No problems here. The volume went down today. It is within the zone, the resistance zone, support 4100, resistance at around 4200, and the chart, technically speaking, is forming a bull flag pattern, waiting and waiting for the next leg higher. But here's the problem. The momentum indicators appear to be running out of gas. They appear to be really overextended. And look at the MACD. It's actually curling down. It wants to stop here and move down. So the candlestick pattern bullish, momentum indicators running out of gas. What about the Qs, the NASDAQ? And by the way, I accidentally removed all of my markings on the Qs chart. These markings go back since what, 2020? So somebody please let me know how can I get it back. I'm pretty sure I'm not going to be able to, but I'm just going to have to do some homework here and look back at my previous charts and redo it again. But anyways, for now, even the Qs remains within range. The support 316, resistance at around 326.47, which we got today, but it goes all the way back since 2020. You'll see that when I zoom out to the daily chart. But it is really interesting that we got a gap and crap. The bears are going to point out to that as a sign of weakness, and perhaps that the rally is stalling and running out of gas. The bulls would say nothing changed, within range, no problems here. So let's zoom out to the daily chart of the Qs, not the continuous contract, the Qs. And as you can see, we have a sloping line of resistance. So we just hit that line exactly. So is it really crazy to say that the Qs might pull back soon? Not really. It is actually due for a pullback. The problem is, what if the CPI exacerbates that pullback into a flush down? This is what the bears are betting on. This is what the bulls are afraid of. Now, here's the daily chart for the continuous contract for the Qs. Still bullish, still forming a bull flag consolidation. No problem here. It is having a hard time to crack above the resistance at around 13,300, but it could do that if there is a catalyst, if there is an extra push that could spark another leg higher, more buying. For now, everybody's afraid of stepping in because we have the CPI. Everybody wants to wait for the CPI to come out before they start buying, because what if the CPI actually produces a flush down? While the candlestick pattern is favorable to the bulls, the momentum indicators not so hot so. The momentum indicators are getting really overextended and they're due for a pullback, meaning we're due for at least consolidation here. That's the best case scenario. We'll see what happens. But for now, what about the IWM? The outperformer for the day. It actually closed positive. It opened the gap, did not close the gap. It is above 191.5. The next resistance at around 196.5. If the Russell gets there in one shot, I will be shorting with both hands because 196.5 is extreme resistance. The bulls are going to look at this chart and say, look at this. The Russell closed in the green big time. No problems here. It captured an important support lines. What not to like? The bears are going to say, well, this was supposed to be an ABC pattern that gets you guys all the way to 196.5. That didn't happen. Instead, we have a pattern of a bear flag, indicating that the gap will be closed and the chart is going to trade again below 191.5. For now, you can't say that the bears have the better argument because the chart is above 191.5. So the bulls are in charge for now. Once they lose 191.5, the bears will be in charge. The Dixie, the dollar index, also known as Tricky Dixie. Why? Because it's going to play dead. Everybody's going to say the dollar is going to go down. Then what do you know? It pops higher again. Well, look at the momentum indicators, the RSI, the MACD. They're actually supportive for pop higher in the dollar. But will the fundamentals support that? The fundamentals being the CPI. What about gold? What's going on here? Still moving higher, but I'm not sure about this rally. I got to see the dollar beaten down, crushed, defeated, smacked in the face. Otherwise, any pop in gold is simply transitory. What about crude oil? UK for Brent. This is a 4 hours chart. We got a bounce of the important, but most importantly, critical support line of 94.47. If the chart loses that for good, it's over. Goodbye. But for now, it popped higher, forming a bull flag, which means we could see more gains here for crude. But I'm not buying it yet. I have some call options on Occidental, for example, and other names, but I'm not going all in buying the dip in oil because I gotta see more. show me the money. Get the chart above 99 so I don't have to be overstressed about losing 94.47, and then maybe I'll be back in. Here's the daily chart for the 10-year yield. We got a pullback today, but the momentum indicators, the RSI, the MACD, they're indicating that there is a pop coming in the 10-year yield. That will only happen if we have a hotter CPI reading. Watch out for 2.72. That is the support. If the chart loses that support, we got a problem here. It goes down, the TLT goes higher, NASDAQ goes higher. Here's the TLT. This is a weekly chart. Still not quite trading above last week's candle, which means the chart is still within range. The risk is to the downside here until we get above last week's candle and close the gap at around 120. The VIX 4 hours chart, what's going on here? It could not make it above the resistance at around 21.53, but look at the MACD indicator. It is curling its way higher. It's about to cross, producing great impressions in the histogram, meaning positive momentum for the VIX. And I have this gut feeling, it's not based on any technicals or anything, that we will see a rebound before hitting 20. Why? Because everybody's waiting for 20 on the VIX before they start making decisions. The bulls are waiting for 20 on the VIX to take profits. The bears are waiting for 20 on the VIX to buy puts. Usually, not always, but usually it doesn't happen like this. Usually, we see the rebound before hitting 20. Here is the VXN 4 hours chart for the VIX for the NASDAQ, still holding at the important support of 27.5. Over and over and over again. This is an indicator that we could soon see a pop in the VXN and a pullback in the NASDAQ, the Qs. And here's the king of the NASDAQ, Apple, the big kahuna. Here's the daily chart, way overextended on the RSI, the MACD, due for a pullback. And my hunch is the pullback will take us all the way down to 157, and then we'll take it from there. Apple is running out of gas. Doesn't mean it's bad or good. It's just running out of gas. If you want more information about Apple, watch the previous video that I produced today, the Buffett versus Burry. We talk about Apple in details. And here it is. Tesla, the souffle, got us all the way above 886. It appeared that it's so far so good. The bulls are back in charge. They're going to close the gap. They're going to get the chart above 935. And what do you know? The chart goes down, melts down all the way till the end of the day. And it stopped at the support of 866.14. Pretty much to the penny, slightly above that, but it did not break below that number to give us the confirmation that we got the permission to short. For all you know, Tesla could be going down to close the gap, and then it pops higher again. So we need to see that critical support line being lost. I would actually go as conservative as 850. If the chart closes below 850, then we got more downside to come. And lastly, BTC, what's going on here? 2 hours chart, we have a double sloping line of resistance. Broken once, broken twice. This is momentum for BTC, Bitcoin. It got the consolidation range. It cracked above the consolidation range, now forming a bull flag pattern. So when we talk about looking at certain bearish indicators, maybe meriting a pullback in the NASDAQ or the SPY, Bitcoin says not so fast. Bitcoin says we're still risk on. So if this bull flag plays out, it's kind of hard to see Bitcoin moving higher, yet the NASDAQ, the big caps, the riskier names in the stock market getting crushed. So I'll be watching the bull flag in Bitcoin. If it melts down, it doesn't play out, that will be a good sign for the bears, bad sign for the bulls. We're talking about equity bulls, equity bears. Likewise, if it plays out, we have the top of the candle at around 24,500, the previous top. That would be stiff resistance, and if Bitcoin runs out of gas at that point, that could come hand in hand with a pullback in the stock market. Now, let's move on to conclude this video. What do we have on the economic calendar tomorrow? We have the small business index. This is really important because it was abysmal last time around. Then we have productivity and unit labor cost. With that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow. Take care.